I will just make one quick comment. I was able to move myself up in the COVID shot list. I'm not quite 65, although the number of years I've been a CPA would put me definitely in that range. But I was able to move up a notch because I re-registered as a last responder. And I did that because other last responders include funeral home directors. And you all know that death and taxes go together. So I figured I must be a last responder.
But fortunately, you're one of the live ones.
Fortunately. So we're going to talk about business, your small business, and the tax tips that are available today for your home-based business. And of course, we're going to start out with those things that are important to know about just having a business, a small business itself. And I get these kinds of questions that come up quite a lot. If I'm a sole proprietor, can I use my personal bank account? And the answer is yes. You can use a personal bank account. The only time that you need a business bank account is when you have a different name to your business. And that's a bank requirement, not an IRS requirement. If they're making their checks out to ABC Company, then the bank needs an assumed business name registration in order to accept the checks in that different name. But you can certainly use your personal bank account. If you have a partnership or an S corporation, and I'll talk about those a little bit in relation to LLCs, then you're required to have a separate bank account because those entities will have a federal tax ID number associated with them, and the bank is going to require some kind of registration in order to open up a bank account. And really the same thing exists for credit cards. Can you use your own personal credit card for your business? Yes, you can. The important thing is to make sure that your accounting program and software is separating your business and personal expenses. And as long as you can provide the right documentation, the receipts for your business spending from your personal account, there's no problem as a sole proprietor. Now, when I say you can deduct business expenses as a partnership through UPE, what I mean is that's the abbreviation for unreimbursed partner expenses. When you have a K1 from your partnership, which is the flow through of your income and expenses, your profit and loss from your partnership, you can have spending on your own, some personal spending for the partnership or on behalf of the partnership, and you can deduct those on the Schedule E, the page 2 of the Schedule E, where your partnership income is displayed without a problem. If you have an S corporation, even as an LLC, if you have elected to file as an S corporation, you must reimburse yourself from your S corporation. If you don't, then those expenses are going to be considered employee business expenses, which are no longer deductible since 2018. In fact, one of the disadvantages to a lot of people during COVID working at home is the fact that they now have all kinds of additional expenses that they cannot deduct if they are an employee, because the tax bill, the 2017 tax bill, eliminated employee business deductions. But having a small business out of your home is the way to go to get those business expenses deductible. Now, tax filing is done as a sole proprietor. If you're an LLC, you've registered an LLC, it's important to know that the LLC does not exist for tax purposes. It's merely a liability protection device. It allows you to gain a little bit of creditor protection to have an LLC and have your business operating as such. But an LLC, if it's a single member, the default is you're going to file a Schedule C, which is a small business, profit and loss from business, a Schedule E, which could be a rental. You have rental property, and that can be considered still a business, or an F, which is a farm. You would have to file some kind of an election. That's that form 2555 you see over on the right column, in order to be treated as an S corporation. If you're a multi-member LLC, more than one owner of the LLC, the default is a partnership. If you wish to file as an S corporation, and there are tax benefits to filing as an S corporation if your profit is high enough. And I can talk about that a little later. That actually kind of deserves its own seminar as to what kind of entity to file. You, in any case, regardless of what kind of business, it is very important, and I'm sure Laura will approve of this statement, it's critical to maintain good books and records, regardless of what kind of entity you have. The number one term that the IRS will grab a hold of, and particularly any prosecuting attorney, if you ever had a lawsuit against you, they love the term commingling, because if they can prove that you've commingled business and corporate, again, it's not so much a problem with the sole proprietor, but with a partnership and a corporation, if they can show that you've commingled funds, you spent personal money on corporate activities, you spent corporate money on personal expenses, that you will lose in court. They will dissolve your corporation and you will be personally liable. There'll be no more LLC protection. You'll be personally liable for that lawsuit. So it's very important that you have good, clear, clean records and a good process when it comes particularly to having an S corporation. Any questions about that before I move on?
Very clear.
Okay. So we'll move on to tax tips, and I pushed this up to number 1. Normally this is number 5 in my list with most folks, but since I'm speaking to the AHB, let's make this number 1. Maybe this is a lot of review for you. I'm hoping that it is, which is fine. Otherwise, here are the basics for deducting an office in the home. It has to be used exclusively and regularly for business. Now, I get those questions all the time. What does exclusively mean? Simply that space or room, does not have to be a separate room, can be a space in another larger room, must not be used for personal purposes. That's why they say move the couch and the TV out of the living room or out of some part of the living room if that's what you want to, where you want to have your office. Set up a desk, set up a file cabinet, take a picture, and make sure then that you can show that you've got an exclusive use space in your home for business. If you have a separate room, that's really the easiest way to then prove exclusivity of use for business. Regularly, a new court case came up, IRS versus Green, not long ago. I don't have the exact date for that, but the tax court determined that used regularly means something about 10 hours per week. So that's about an hour and a half a day or so. If you're only in there half an hour a day, you may have difficulty proving that that space was used regularly for business and would then lose the deduction. Now, as I said, it can be a separate room or an area of the home.
If you have 2 businesses or 3 businesses, do you have to have a different room for each business?
You do not. You can use the same space for all 3 businesses. What you can't do is double dip or triple dip. You can't take the same expense 3 times. So if you're going to calculate office in a home, let's, for example, say your office is 10% of your home, then 10% of your utilities, 10% of your homeowner's insurance or renter's insurance, 10% of your mortgage interest, 10% of your real estate taxes, 10% of cleaning, your Lysol, your whatever kind of repairs and maintenance, 10% is deductible as an office in a home. You could then take a third of that for one business, a third of that for another, and a third for the third. But you can't suddenly take 30% of those expenses because you've got 3 businesses. It's still going to be limited to the square footage of your office space. Now, what's really nice is the IRS is becoming more and more liberal about what is a home office, what qualifies. If you have an office, and I'm speaking particularly to Brandon, you're an ophthalmologist. You do ophthalmology not in your home, I guess. So previously, the IRS said you can't deduct an office in your home if the primary portion of your work is somewhere else. So you would practice your ophthalmology in another location, you could not deduct a home office. That has disappeared now. A home office can be used for administrative purposes only. It could be done for the convenience of the employer, which is yourself in your own small business. But even in that ophthalmology practice, you still might be able to deduct some of the office in the home expenses because it's a place where you can have privacy from your patients, where you can study journals, where you can read the latest magazines, you can do your accounting, your administration work, your marketing. That qualifies a home office now as deductible. And of course, when it comes to storage of inventory, I get this question a lot. Can I deduct a portion of my garage? Because I have an Amway business and half my garage is filled with room cleaner, house cleaner. The answer is yes. You would add the square footage of that garage space to both the amount of office space you have and the total square foot of your house, which usually does not include the garage. Normally you look at the assessor's website and it'll say living space, and that's upstairs, or that's all of the rooms other than the garage. So if you're going to use part of your garage, part of your unfinished basement, part of your unfinished attic, if it's not already included in your home total square footage, you'd have to add that space to both the numerator and the denominator of that ratio, but you'd still get a higher percentage for business use. Now, this is a change just in the last 2 years. If you have an, Sheldon, do you have a question?
No.
Oh, okay, thought I saw a hand.
I did. Kevin, before you get too far away from it, the space section on your first part there.
Yeah.
10 hours per week, is that or 1.5 hours per day? Would that would be an average? So if you'd work like 20 hours on Saturday.
You could skip a week.
Yeah, okay.
Yeah, it's an average. It does not mean, it's not 1.5 would give you, 10.5. So you don't have to try to get that down to the gnat's eyebrow, as they say. It just, yes, on average, 10 hours a week is a starting place to be able to prove regular use.
Right. Okay.
And really, a lot of this, most all of this that I talk about, it's in the proof. You don't need to prove anything when you file a tax return. You could list anything on a tax return. The question is, are you going to get an audit? And then would you be able to substantiate all of the things you put on your tax return in that examination? So this is that area. In an S corporation, and I'll bring this up a little bit later, but those expenses, it used to be that the recommendation was rent yourself your home office, rent your office at home to your corporation. But the IRS states that you cannot deduct landlord expenses personally on your individual return for office and home that you lease to another business. So it would be a wash. You'd get a deduction in your S corporation for the rent you'd pay yourself, but then you have to pick up that rent as rental income. So there's no benefit there. With an accountable plan, what you're doing is you're going to add up the expenses you incur, a portion of your utilities, as I mentioned, a portion of your insurance, taxes, interest, cleaning. Calculate, and I would recommend using that form 8829 as a guide. That's the office in home form, to calculate that expense, and then you submit an expense report to your corporation each month, and the corporation then pays you, writes you a check to, and I wouldn't just, it's a lot of people just say, well, you know, I distribute money all the time from my corporation, my S corporation, to myself. I take dividends all the time. Can I just count some of it? That isn't going to look appropriate to the IRS. You need to show an expense report that you actually reimburse from your S corporation, and then you get the deduction in the corporation, so your profit is less, that flows through to you. Then you get rental income that you pick up, but now you can take all of those expenses for that office in the home against your rental income, because you're reimbursing that expense. So there's a way to add. You know what, that I'm going to stop myself for a second. I got myself in a snowball rolling downhill, because that used to be the case. The reimbursed expense in an accountable plan is not income. So you don't have to worry about the home office expense. Those reimbursements from your S corporation, you don't even pick that up on your personal return, but you get the deduction in your S corporation.
What is the amount of money that, just a general amount that you should make to do an S corp?
I'm going to give you this rule of thumb, which I think is pretty accurate. I don't see this anywhere else, but I've figured this out over 37 years being a CPA. You have to pay yourself a reasonable salary as the employee of your own S corporation. So you're going to have some extra expenses. You are going to have Social Security and Medicare. You are not subject, as the owner, you're not subject to unemployment insurance, whether federal or state. And you have things like TriMet anyway, but you also have self-employment tax on the profit from your small business. So that really is the same as self-employment tax, which is the Social Security and Medicare. And that's what the IRS is looking for, because in an S corporation, the profit that distributes out to you is not subject to self-employment tax. That profit is not subject to Social Security and Medicare. So the IRS has made it very, very clear that you have to pay yourself a reasonable salary so that they can still collect their Social Security and Medicare on that salary. That gives us a foundation. You take whatever you believe would be your reasonable salary, however minimized that might be. But again, that's why they use the term reasonable. And the IRS doesn't give any guidance. So I recommend you go to salary.com, you go to Robert Half, you go to anywhere. I think some of these other placement services online have salary guides where you can look and see how much would I have to pay somebody to do what I do. Plus, you need to add something for the fact that you're the manager, you're the owner of this business, and you've got to administrate the business. Once you figure out that reasonable salary, add 7.5%. because 7.5% is the extra Social Security and Medicare that you'll have to pay, that matching from the corporation. Once you've got that figure, if you have a profit of at least $10,000 above that base figure, reasonable salary plus 7.5% of that salary, and you have 10,000 in profit above that, you will save enough to break even on having an S corporation. So if you determine that your, let's say your reasonable salary minimized is $40,000, 7.5% is 3,000. So if your base is 43,000, if you have a $53,000 profit before that salary, then that $10,000 savings will allow you, I'll be exact here, you'll save $1,413 in tax. Now, if I do your S corporation tax return, I generally charge between, depending on how complicated the return is, between $750 and $1,500 for an S corporation return. So let's just say it's $1,000 average. You'll find people much higher than that, and there are people that will charge less than that, but typically not less than $500. In any case, $1,400 will cover the cost of tax preparation of that S corporation. Plus, you also have to be concerned with payroll. And if you hire us, we also provide payroll, shameless plug. We charge for a single check once a month, $75 a month. So you're looking at there, you're looking about maybe about another $900. So that's about 1,900. So actually 10 to 15,000, maybe 15,000 would be a better figure in this day and age to above. So the 43 is your salary plus tax, plus 15 is going to be 58, near 60,000. Let's say in that example of profit would save you enough to cover the cost. That's the break even. But now as your profit increases, you're going to continue to save on self-employment tax. That was the short answer. Now, the two ways to deduct an office in the home are square footage based, as I've mentioned. You take the percentage of the square feet divided by the total square foot of the space. Now, here's something very important that a lot of people haven't heard. You can exclude hallways, staircases, closets, bathrooms, crawl spaces, foyers, outside walls from the total square foot of your house. That reduces the denominator so that your percentage is greater. So you want to add those things up and subtract them from the total square foot. Or there's a de minimis rule. If your office is very small, well, up to 300 square feet, maybe that's not that small, but you can simply deduct $5 per square foot. But generally, you can get more of a deduction than $1,500 by taking the square foot and multiplying that by all of your home expenses. Now, you must have a net profit from your business in order to deduct an office in the home for expenses other than interest and taxes, because those things would be deductible anyway. So you can still take a portion and deduct it against your profit from your business of interest and taxes, but a percentage of utilities and cleaning and homeowners insurance, you could carry over that extra expense, but you couldn't deduct it if you have a loss in your small business. So in order to really maximize the deduction, I'm just kind of reiterating what I just said. For a sole proprietor, you fill out the 8829, you have to have a net profit, but you are allowed to deduct mortgage interest and property taxes even if you have a loss in the business. As a partner, you can deduct an office in the home simply by filling out an 8829 and calling it unreimbursed partner expense. Partners are treated more like sole proprietors for this purpose. But if you're a shareholder in an S corporation, don't rent from yourself. You need to use an accountable plan, which means you have an expense report that you provide to your corporation, your S corporation, and then you reimburse yourself. And the requirements are that those expenses have to have a business connection. You have to substantiate with bills and receipts. You cannot pay yourself, well, you have to be careful about giving yourself a flat fee. That doesn't work. That disqualifies the accountable plan. So you have to make the reimbursement for the amount of the expense report. And the reimbursements must be timely. So monthly is the optimal rule there. You can advance, your corporation could advance you money, but you have to, within 30 days, make the actual expense. You can't wait 6 months and then spend the money that you're being reimbursed for. You have to substantiate the expense within 60 days. You have to return any excess of that advance within 120 days. And if you have periodic reimbursements, let's say quarterly, then again, you can substantiate the expense within that next quarter. But you can't wait 6 months or a year to reimburse yourself for all of your home expenses. Okay. We move on. Any other questions about the home office? All right.
Now, if I have a good accountant, they'll take care of all of that, won't they?
Absolutely.
Okay.
Absolutely.
I slept through that part. Good. That's what I thought.
Thanks, Sheldon. Business mileage is defined as every stop on your day from the first business stop until the stop before the last leg of the trip home. So the leg of your mileage from home to your first business stop, this is what's typical, but I'm going to show you what changes for having an office in your home. So typically, if somebody works for a company as an employee and they're asked to go pick up some documents or whatever from someplace else, stop at the post office, from home to that first business stop is commuting. But then from that PO box to the office, to your next business stop, or picking up some office supplies, that's marked green, that's business travel. To the next stop, now you have a meeting with somebody at a coffee shop regarding business, so that next leg is deductible as well. And then the last leg, home, typically is not deductible, it's considered commuting. But when you have a home office, you have no commute. Or you could consider your commute as being from your bedroom to your office space. It's a walk down the hall. That's your first leg of your trip. So then every business stop along the way from home out and about. Now, of course, you would have to subtract the trip from a business stop to the grocery store to pick up food for home, unless you also picked up some office supplies at Fred Meyer while you're there, and so on. Then all of that is going to be, all your mileage would be deductible for those business trips. Now, you have a choice. I'm going to kind of zip through this a little bit. You can take either, oh, a little too far. Let's go back. You can take either standard or actual expenses. The standard mileage allowance already includes depreciation. And for 2020, the standard mileage allowance was 57.5 cents a mile, which is good. I mean, considering that gas prices were so low in 2020, that mileage allowance more than covered all of your operating expenses. The other option is to take actual expenses. Now, in either case, you must keep track of your mileage. I have this issue all the time. People say to me, well, I'm deducting actual mileage, actual expenses, my gas, my repairs, my car washes. Why do I have to track mileage? Because you still have to come up with a business usage percentage. Now, if you have two cars and one is 100% business, you don't need to keep track of mileage for that one car. But like most people, you have one car that you're using for business and personal. You then have to keep the mileage on that car, because then if you're using standard, you're going to take the standard deduction or the standard allowance times the business number of miles. If you're going to use actual expenses, you'd have to come up with a business use percentage, which is taking business miles divided by the total miles you put on the car. And then you can multiply that by all of your operating expenses.
What if my car is completely wrapped in my business logo?
That is no longer acceptable by the IRS. It used to be. People would say, I have a boat and I'm going to take all of my clients on it. That's all I'm going to use it for. Well, I should say under the last year, they expanded entertainment expenses. But previously, if it was, that wasn't allowed as a personal deduction. And wrapping your advertising around your car does not make it business 100% of the time. That was thrown out by a tax court case. You still have to track your miles, and there still has to be a business purpose of the actual trip that you took. Now, whether you take standard mileage allowance or actual expenses is on a car by car, it's on a vehicle by vehicle basis. You could have one car you're deducting standard mileage, and you could have another car that you're deducting actual. In fact, a lot of people, if they made a lot of money one year, they go out and buy a 6,000-pound SUV. That qualifies it as a business truck. You still have to multiply the expense by your business usage percentage. But some people bought an SUV on December 31st, and they drove it 5 miles, and all 5 miles were business. That meant they could deduct 100% of the cost of that SUV as of last year. And I had a client do that. So she got $38,000 deduction off of her Schedule C because she bought it. But now, because she's depreciated the entire cost, she's going to have to keep actual expenses for the life of that car and keep her mileage, of course. So I'll have to now get her to add up all her gas receipts and there won't be any more depreciation because she's taken it all. So it'll just be a percentage of her gas and repairs and so on. So what I like about the standard mileage is, even though your deduction might be smaller, because you're not going to take that big depreciation deduction when you buy the car, you can continue to use the standard mileage for the life of the car. So even though the depreciation might run out after 5 years, let's say, normally, you can continue 10 years, 15 years, taking the standard mileage allowance on the automobile. So you're getting that extra benefit from having the depreciation included.
Kevin,
Yes.
I'm not doing a lot of travel, but would going to pick up a paycheck from across town count as business travel?
Yes.
Okay.
Yes, it would.
So,
Okay.
Kevin,
Yes.
I have another question along with just, so you have your business office at home, but say you have a production facility, someplace else that they actually are producing your product for you. So it would not be commuter miles to and from that facility, even though you may visit it like 2-3 times a week.
That is not commuter miles because you have an office in the home.
Okay.
That's correct. Okay. Business travel. So any kind of business travel is different than just traveling around town. So business travel is defined as sleeping away from home, that a place where you stay overnight and you conduct business. That then qualifies for business travel deduction. Now, there is a preponderance of use, I suppose you can call it, which will show how much of your transportation costs will be deductible. The fact that you're there on business means that the expenses you have while you're there for lodging, meals, incidentals, toothbrushes, toothpaste, you got to buy a satchel or something while you're there. Those are incidentals and they qualify if you're on travel for business. But now the question has always been, well, what about the transportation costs? What about that airfare to get there? So the new rules adjusted have to do with, first, is the trip outside the United States and DC, or is it within the United States to another state where, again, you stay overnight on business? So the 5149 test really has to do with 51% of your activity where you are. So preponderance of your activity, wherever you're located, is business. If your trip is outside the US and you can pass, you can't pass that. So you fly to Florida, you have 2 days for business trip and 5 days for the week to go visit Orlando and the Disney World and so on. You cannot deduct your transportation costs. Although for the 2 days that you're there on business, you could still deduct your hotel, your lodging, your meals, and so on, because those 2 days were spent with business. But if you spent 4 days on business and 3 days going and traveling and visiting, you could deduct 100% of your travel, your airfare to Florida. Now, if it's outside the United States for 7 days or less, 100% of your transportation is deductible. Again, that has to be 7 days for business. If it's for more than 7 days, then it has to be quite a bit more business use or business activity on your trip in order to be able to deduct the business percentage of the transportation cost. So 80% of your time in France is business. You could deduct 80% of your transportation to get to France and back. Any questions about that?
Go ahead.
Okay.
No,
So, oh,
go ahead, Becky.
if I have a job as an editor of a newsletter for a national organization, and then I attend that organization's conference and pay conference fees to do so, would that qualify?
Are you earning money from this, from the work that you're doing for that conference or for that national
For the
organization?
Yeah, I mean, not a huge amount, but it is a paying job. They're paying me a stipend, like $300 a month.
Okay. Yes, it is deductible. I think what you'll have a problem if, because it starts to fall into the hobby loss rules, where you generate a loss in more than 2 years. Now, under normal circumstances, some businesses just lose money. But after 2 years of losses, now we've just gone through a period of much lower income and losses. This is going to be an exception to the typical rule of hobby loss. But going forward, if you have more than 2 years, it doesn't mean you can't deduct the loss. It just means you're more susceptible to an audit where they will scrutinize your profit motive. What's your incentive? And if you're incurring more expense than you're earning, then it may turn out that they'll deem it a hobby. And you can deduct the expenses still, but only up to the amount of money you earn in that hobby. Because hobby income is still taxable, but you get to deduct expenses, but you cannot create a loss.
I see.
Now, I'm not saying that you can't, I mean, you can, certainly a lot of businesses, farmers, for example, have lost year after year after year. Ranchers have lost year after year after year, but in the fourth, fifth, sixth, timber harvesters have losses. But in the fifth year, sixth year, 10th year, you better have a substantial profit that is over and above all those losses you took for those intervening years.
Mm-hmm. And there's no tax breaks. I mean, if you're not making money, then you can't deduct anything. Like as a volunteer, being involved with a project.
No, well, you can volunteer work, and spending money to volunteer for a qualified nonprofit organization allows you to take a charitable donation. But a charitable donation doesn't have the kind of tax benefit that a business expense has. So that's why I'm focused on the business expense aspect. But yes, if you spent that money and it was in relation to a charitable organization, qualified charitable organization, then yes, you could take it as a charitable donation.
But so like I donate, a group of Gladstone business people, businesses got together to feed the people during the ice storm. There's no qualified nonprofit there.
There's no qualified nonprofit there.
Yeah.
So you don't get a charitable donation deduction. Now, did you say you were doing business there? Were you selling pancakes there, or?
No, I was donated it all.
Yeah, so the way to make that a donation is you find a sponsor, like a church, and you get the church to sponsor the breakfast or the food giveaway, or you do it through the food bank, through Snowcap or Oregon Food Bank. So then it's under their umbrella, and then your donation and your expense would be tax deductible.
I see.
All righty.
I think same way with the fires. I don't think there was any, when the fires hit in the fall, I don't think we just went and fed at where they were camped out because they got displaced. There was nobody sponsoring it.
There was no Red Cross there, or no any Oregon organization?
Well, I think Red Cross was at one of them.
Yeah. Well, you volunteer for Red Cross and then you say, here's what I can provide. And let it go through Red Cross. Anyway, something to note for the future. So
hold on, Kevin. So the state and federal government don't qualify as qualified nonprofits, huh?
No. Are you kidding me? All our legislators are in it for profit.
I actually did have a question on the travel expenses. I have property in another state.
Okay.
I do travel occasionally there to do maintenance and stuff like that, but I fish while I'm there or something too. So as long as, I guess what you're saying, the travel expenses to and from, as long as my work 8 hours a day is towards the rental property, then it's covered.
Right, and you could, again, a standard is 4 hours a day.
Okay.
So if you put in 4 hours a day, that whole day counts as business. So you did some work one day and you know, in the morning, and then you work the next day in the morning, and you know, you could easily get quite a few days to add up for business.
Okay.
Yep. So then the question is, do I take actual or per diem? And actual expenses, there is a per diem chart that the IRS has, and they allow a certain amount based on the city that you're in and the time of year. It's usually per quarter, I believe, and they have come up with the Department of Labor has come up with a per diem schedule. Generally, it's used for employees, so employers can pay their employees just based on the per diem rate schedule and not worry about the employee having to report back their actual expenses. That the IRS allows that. But for sole proprietors, home-based business owners, you can also take the per diem rate, but only for certain things. The actual has to be for transportation, lodging, and meals and incidental expenses, but the per diem only covers meals and incidental expenses. So if you go and you find that on the IRS per diem schedule that they will allow more than what you'd go out and spend at In-N-Out Burger, then you can take the meals and incidentals expense per the IRS per diem or the Department of Labor per diem rate schedule. Whereas transportation and lodging has to be what you actually spend. So if you stay with a friend, wherever it is you go and fish, and you look after your rental property, then there's no expense there. You don't get any deduction for lodging. How much time do I have left?
You got time. It's fascinating.
Oh, okay.
Mark, Kevin, are you going to be able to get to healthcare at all? Because I think that's a pretty big expense for a lot of folks. And
Healthcare. I actually wasn't. Well, I'll tell you where I can get. You know what? Let me zip through, and we'll get to a portion of healthcare.
thank you.
Okay. So if you have a cell phone for business, you can take 100% of the deduction on the cell phone. Now, I've been at several audits where the auditors, I have to argue this point. If you take 95% of your cell phone bill, they won't even question it. But if you take 100%, now they're going to start to ask, well, do you have another phone? Do you have the highest plan? Does it include data? You know, does it include, you know, are you on a plan with your kids? You can't deduct. So you do have to exclude some personal use if there is such. Same issue with internet. I've had IRS auditors that argue with me 100% deductible, but you have to have the internet in order to conduct business. So generally, if you have to have an item and have to spend the money anyway because you need it for business, then it is 100% deductible. Rule of thumb. If you do have a second line that's a business fax, that is certainly 100% deductible. Let's say you have a second line at home. You have a home phone. Not very many people have one anymore. But if you have a second line that you're paying for that you use as a business fax, that's 100% deductible. And if you make and receive calls from your home phone, you can take 50% of that. You don't have to track which calls are business and which are personal. If you do make and receive calls on a home phone, you can deduct 50%. But if you can show, now long distance is gone, I guess, virtually gone. But if you did have any long distance charges of any sort, you could then add those up and deduct 100% of those specific charges in addition to these other things. Meals and entertainment. This has gotten a makeover, I should say an extreme makeover. This was a much easier topic to discuss, but I'll be happy to I can send this PowerPoint. You know what, I didn't see, Mark, your email until I was already online, but you were asking about my uploading it, and I can certainly send this to you so you can upload it, or whoever can upload it on the website, so you have all of this.
Yeah, if you would, that would be great. We'll find a place to place it in the website.
Sure. But there are all kinds of changes to meals and entertainment. Fortunately, they've changed a lot of them back, or even better than what they were, because the original Tax Cuts and Jobs Act that got passed in 2017 originally removed meals and entertainment completely. You couldn't deduct them at all. But then they made a modification to it in 2019 that allowed 50% deduction. And now the CAA, which is this bill that Biden just signed into law a week ago, it's now 100% deductible under certain circumstances, but that's only going forward from 21 and on. Well, I should say 21 and 22, because then it sunsets and we go back to the 50% deductible under the TCJA. So it now pretty much depends on if you're meeting with, if you have to meet with a prospect or an employee or an associate. One of the things that I did want to get to, which will cover some of the health insurance issues, is hiring family members. Because family members, if you hire family members, a spouse or kids and kids under the age of 18, then they are considered workers. And so a meal out with your spouse is now would be 50% deductible as a business meal. So you can see all of the entertainment costs for prospects or clients is no longer deductible. But if you have a meeting that involves entertainment and a meal, like going to a ball game, then the meal portion is 50% deductible, just the meal portion, but it has to be separately stated on the receipt. So if you buy some kind of package deal, I bought tickets to the ball game that included a couple of hot dogs and a beer or whatever, then there's nothing deductible there. Okay, can I skip on? So that'll be up on the website so you can have more time to study it at home. You must document for any meal or event that oh, 75, okay, this is just a talking point. If it's under $75 per meal or event, you do not need a receipt. You do not need a receipt, but you still have to be able to show an IRS auditor that you incurred the expense. Now, generally speaking, what that means is keeping some kind of a logbook, a calendar, that somewhere you've written down where you went, who you talked with, what you talked about, and how much it cost. Because the IRS auditor has got to be able to add up your meals deduction. So, but the IRS rules, the tax code says if it's under $75, 75 and under, you don't need to present a receipt. Blue ink in your paper calendar works just fine for that. But if it's over $75 per the event, per the meal, let's say, then you're required to present a receipt if you get audited. Okay, this is the one I want to at least leave you with on this one. So if you hire your family for children under 18 years old, you can pay each child up to $12,400. That can include a wage, bonuses, educational expenses, training, but it has to be not just your college expense. It has to be training, classes that help them in your business. Though you do not, you still have to report their wages, but they're not subject to any employment taxes. Under 18 years old. They're not subject to Social Security or Medicare or any kind of unemployment insurance. And the reason I say 12,400 is that's the standard deduction, the new standard deduction as of 2 years ago, that every person receives, even if they don't itemize, unless itemized deductions are greater. But that child will not have to file a tax return if they earn up to $12,400 in the year. So you give them a W-2, you put them on the payroll report, you file it quarterly, no withholding, no payroll taxes, and you get a $12,400 deduction in your business. They only have to file a tax return is if their earned income, which is the salary, is greater than $12,400, or if they have unearned income, interest or dividends or capital gains. Grandma gave them stocks in Disney and it's in a portfolio and it earns them dividends of $1,200. Now they're going to have to file a tax return. But otherwise, just paying your 16-year-old $12,400 will save you on income tax and self-employment taxes because it's a deductible in your business. Then what you can do is you can say, all right, you're now responsible to pay your share of living expenses, and we'll put that money, by the way, it entitles them, because that's earned income, it entitles them to open up an IRA. It entitles them to open up a Roth. They could make their own contribution to a 529 plan. So I don't know that how many of you are in this category with children that are under 18 years of age, but something you can pass on to your children, your kids, if they have kids and they're self-employed. Now, if you have an S corporation, it doesn't work quite so well, because they're no longer employed by you, their mom or dad. They're now employed by this separate entity, a corporation, and now they're subject to all of the employment taxes. Whoop. Oh, shoot. That's not where I wanted to go. You know, I did that once before in a presentation. Sorry about that. Okay. Except that if a child is under 18, they are not subject to travel. This is the part of the presentation that they edit out. Okay, where we are. They're not subject, if they're under 18, even hired by the S corporation, they're not subject to the employer's share of Social Security, Medicare, or the federal unemployment tax. So there is still some savings there to hire your children in your S corporation. But if children are from 18 to 20, they're subject to all the employment taxes, including the FICA, but they are exempt from federal unemployment tax only. And of course, the reason I say to 20 is 21 and older, they're going to be treated as any other employee. And you should treat them as any other employee as well. Well, that was a little bit of accounting humor.
Very droll.
Human resources humor. here's where we get to the medical, at least we touch on the medical issues. So if you're sole proprietor, you can hire your spouse, but you don't need to pay them wages. You can pay them with tax-free benefits. Your spouse can create a medical reimbursement, or you can create a medical reimbursement plan where you determine how much on an annual basis you will reimburse every employee. Now, if you have other employees other than your spouse, you're going to have to reimburse them the same amount as your plan states. So this really only works if you are just employing your spouse. What happens is the spouse goes out and gets a medical plan that's in their name and covers the entire family. Then, go back a little bit, then they submit an expense report to your business for the amount of the premiums and all other out-of-pocket medical expenses, not only for themselves, but for you and for the kids as well. So that spouse can then submit an expense report, and it really ought to be, timeliness is important. It ought to be monthly, can be quarterly, but I wouldn't do it any less frequently than quarterly, that your business writes a check to your spouse to reimburse all the medical expenses. And all those medical expenses are now deductible in your, against your business profit. The other things you can do is you can pay with other fringe benefits, such as education. You decide to pay for your spouse's college courses as part of their compensation. They can take out a up to 50,000 group term life insurance policy, and the premiums can be paid for, can be reimbursed to your spouse. You can reimburse your spouse's smartphone cost, and you can actually provide other de minimis items like meals, snacks, small gifts, etc. All these little things can be provided to your spouse as part of their wage. You do not file payroll taxes. You do not give them a W-2. They don't pick this up because as income because they are reimbursed expenses, but you get to deduct all these things in your business.
Kevin, Mark,
Yes.
so on these expenses and stuff, say you're sole proprietor, you have your spouse on the payroll doing exactly this for the first 5 years, and then you decide you have to get, a couple more employees. Can you grandfather in that employee up to that 5 years and then change the rules for employees hired after a certain date?
Unfortunately, no.
Oh, okay. So once you change the
Unfortunately, no.
rules, it has to be changed for everybody, or everybody has to be included.
That's correct.
Okay.
That's correct.
So, question though, if you do this and your spouse is an employee, if they're doing work for your business, how do you get around the requirement to pay them at least minimum wage?
That is a good question. And the minimum wage, I'm going to get to that in the next slide. So
Okay.
all these medical reimbursements and fringe benefits count as their earnings, and that income would make them eligible for an IRA contribution. Because now they have income, it's earned income, although it doesn't show up as wages on the tax return, but it still allows them to contribute to an IRA. Let me just see. So your spouse has certain requirements. They have to do actual work in your business. I mean, it can be as simple as office maintenance, but they do need to keep timesheets. You do need to actually pay your spouse. So there has to be some expense. There has to be a reimbursement, a check that goes to your spouse to reimburse all of those expenses, the medical expenses. You need to spend money for those fringe benefits. You can't just say, I'm going to be nice to my spouse from now on, and that counts as wages. So the spouse pays the medical bills and submits the expense report. You reimburse regularly. The spouse has to work under your control and direction.
Naturally.
Of course. And the compensation must be reasonable. Don't overpay. So this gets into the reasonable means that the value that you're providing to them must equate to at least minimum wage for the amount of time that they put in. So, but a reimbursement of medical expenses can be significant, particularly including health insurance premiums. And as long as that, you just divide that by, and in Oregon, we're at 12.95, or are we at already 13 something? I don't recall. I have someone that does payroll for me, but so I don't keep that number. But you'd have to make sure that the amount of time they spend is at least equivalent, and that what you're reimbursing and providing is equivalent to that minimum wage.
So you don't have to just pay so it doesn't have to be a wage. You're allowed to compensate someone with these reimbursements.
A spouse.
Well, a spouse, yeah. Okay, a spouse. Hey, I married him. He's legal. He's totally legal.
Yeah.
Wow. Okay, this is good.
Right. Yeah, it's a significant benefit.
Yeah.
Unless you have medical plans where you're covered somewhere else, and most of your medical expense and so on is covered, but you're not required to file taxes, and none of this is subject, payroll taxes, and none of it is subject to payroll taxes, no reports. And you don't have to give your spouse a W-2.
Right.
So
And there's no 1099, there's no nothing.
Nothing.
So Kevin, just to kind of clarify, for an example, say your spouse's medical plan for your spouse and the family, which includes you, is $2,000 a month.
Right.
And they work only 10 hours a month, or well, say 10 hours a week. So that's 40 hours. So that's roughly $500 a month. You wouldn't have to pay them anything in addition to that.
That's correct.
Take 40 hours times the minimum wage, approximately 13. You're going to get around $600 a month, right?
Oh, but you're saying that the medical plan is about $2,000 a month?
Yeah, I'm just, that's way out there, I realize.
And
but
you're well above what would be required to cover minimum wage.
So in other words, their hours they work that month, since they're paying $2,000 in the medical plan, would have to be more than $2,000 divided by $14 an hour.
Right. Well, they don't have to work that much, because you can pay your. Oh yeah, so.
Well, I'm just saying, if you're looking at minimum wage at $2,000, so you have to pay them at least minimum wage, right?
At least minimum wage, but there is a concern too about not overpaying.
Right. Well, we don't want to overpay them. That'd be
right. So then the question is, can you justify $50 an hour?
Right.
The work that they do. Or you don't reimburse them for all of their medical insurance premiums.
Right.
You can pay somebody $50 an hour. You can pay somebody $75 an hour. But the question will be, is that reasonable for the work that they're doing for you?
Yeah, so $2,000 a month in medical expenses, they'd have to work about 150 hours during the month to cover the minimum wage.
Right, and at 4 1/3, they'd have to work 35 hours a week.
Right.
So that might be a little excessive. But that's at
Yeah, but my
$14.
wife thinks she
What if you paid
deserves a
him,
lot.
what if you paid them $50 an hour? So now you're talking about, 400 hours for the month divided by 4 1/3. Now they just have to work 92 hours a week. Is that a lot? That's a lot. 2,000 divided
Per
by
week, it's a
$50.
lot.
Oh, it's 40. What am I doing? 40
Yeah.
hours a month divided by 4 1/3 weeks. Sorry, the decimal place was off. They only have to work 9 hours a week.
Right.
And so is this doable if you've got a single member LLC, so it's a disregarded entity?
Yes, that because you're a sole proprietor.
Yeah.
Yep. Yes, indeed. Now, did we lose? It looks like the fellow Brandon, was that his
Yeah,
name?
Brandon had to leave, so
Oh.
just
He
but
wanted-
if you could just cover all the medical stuff, because he'll give him, we'll send him out or give him a copy of this. So
Okay. Well, so I'll just have to talk off the cuff. I don't have a slide for medical per se. The biggest change was 2 years ago where they no longer required you to have medical insurance. There's no more penalty for not having medical insurance. Now, whether that gets changed under the Biden administration, I have a suspicion it probably will be, but be that as it may, there's no longer a penalty. So nobody has to have medical insurance any longer. In 2018, was when the 2017 tax law came into enactment, came into being, that you could still get medical insurance through the marketplace, through healthcare.gov. And you could still apply because Obamacare in that form it still exists, which means you can still enter in how much you believe you're going to earn for the year, for the upcoming year, and get a premium tax credit to assist you in paying for the insurance based on your level of earnings. Now that premium tax credit is called an advance premium tax credit because it reduces each of your monthly premium payments, but then the piper comes calling when the tax return is filed because that's when you report your actual income for the year, and you may find that you're not eligible for those tax credits like you thought you would be because you had more income than you were expecting. And now you have to repay the advance premium tax credits. So that's really the major difference now between the original Obamacare, which imposed a penalty for not having health insurance. So everyone scrambled to get insurance on the healthcare.gov website. And now, when it was made no longer a requirement, no longer mandated to have health insurance. I'm sorry that Brandon had to leave. If he had any other questions, I can answer them. And maybe what you can pose is any one of your members that has any follow-up questions, you're welcome to email me. I don't know that I'll be able to get to them immediately. Even though it doesn't look like it, I've got tax returns up to about here. Well, about here. I'm still taking on new clients. We are continuing to grow, but I'm usually a day or two out on answering emails. But if there are any follow-up for healthcare or anything else we've covered in the seminar, I'm be happy to answer them via email.
Didn't they extend the filing deadline today?
Yes, they did. And Oregon follows suit. So the new deadline for federal and Oregon is now May 17th, and that includes any amount you owe. So if you owe taxes for 2020, there is no penalty for paying those taxes by May 17th. Now, you don't have to file an extension form. If you're planning to put your tax return together after May 17th, you'd have to file the typical tax return extension form.
Now,
But May 17th is the date. Yeah.
what about PPP and EIDL stuff? How does that affect taxes?
EIDL does not have any effect on income taxes because it's a loan. Now, there was an advance EIDL of up to $10,000, and that's actually considered part of the PPP. That is not taxable income and forgivable. But you do have to file the forgiveness, which has now become much simpler, up to $50,000 of PPP and advance EIDL to get that forgiveness. And all of your expenses are deductible. There was a huge question and concern. As the law was originally written, the PPP was forgiven, could be forgiven, but you could not deduct your expenses that you paid with your PPP money. And that follows the IRS tax code that says any expenses allocable to non-taxable income are not deductible. But Congress came through after probably receiving tens of millions of complaint letters. Congress reversed course and said, in this particular case, we're not going to follow the original tax law. Money you paid with PPP money is still deductible, fully deductible, and you do not include your PPP money in income. If you got grants from any other sources, those grants are taxable. If it turns out that they are not taxable, then your expenses will not be deductible. So Multnomah County was issuing grants to small businesses. And Oregon had various CARES fund and so on. Oregon was issuing grants. They are taxable income, but you do get to deduct all of your expenses.
Yeah, I got 2 of those, but they were in January of this year. So they won't affect last year's taxes.
Correct. But the EIDL, which was that emergency income disaster loan, that's a loan. It's not forgivable, and loans are not included in income, but you do have to repay it. The interest on that loan will be deductible as you repay it as business interest expense. Any other questions? I'm going to put up the, so there's my question comment. The one thing we can all look forward to in the future is tax simplification, right?
Right.
And here's an example of the new legislation. So here's an example of what tax simplification looks like to Congress. This is an example of the instructions to a partnership K1 and all the other forms that are involved with having this one document from your partnership where all those numbers have to get reported on all those other forms. So whenever Congress says they're going to be simplifying the tax code, you can expect something like this. So, are there any other questions? Eric, take off mute.
I beg your pardon. I got a telephone call and had to mute and forgot to turn it back on. I was thanking you very much for this extremely informative talk and also an entertaining one. And I said I hope we can get you to do it again next year.
I'd be happy to.
That'd be great.
What about how does I mean, maybe this is more personal, but what about the stimulus money we got?
Okay, good question. The stimulus money, first of all, I have this question come up with every single tax client. It is, you are required to report on the tax return both stimulus payments. The one last spring, some people didn't get it till December. So when I say spring, they argue with me. Oh, I didn't get to mine till September. Well, we're just going to call it the 2020 stimulus payment. That was up to $1,200 per adult and generally $500 per child, qualifying child. And the one that came out in January, which was for a lot of people, $600 per individual, including children. Though both of those amounts, total amounts, are required to be reported on your 2020 income tax return. What they are considered to be advance federal credits, tax credits. You do not have to repay any amount that you might be overpaid based on your 2020 income. But if your 2020 income is less than your 2019 income and you didn't receive all of the $1,200 or $600, then you could have extra money coming back or a lower tax bill for 2020 because they're giving you credit for both of those stimulus payments. So it's important that you list them both and the amounts on your tax return. This new $1,400 payment will be accounted for in 21.
Yeah, but I didn't get the $600 till January 2nd.
Correct. That's correct. So that's a 2021. Yes, I know. That's why I'm saying that payment, not this latest $1,400, but the $1,200 payment last year and the $600 in January 21, both of those payments must be reported on your 2020 tax return. Even though you didn't get the $600 until January. That one is required to be reported on your 2020 tax return. It will not increase your income tax, but they are reconciling it, and it may involve an extra tax credit for those that didn't get the full amount and their income went down.
It gives me a headache.
That's why you have a good CPA.
That's right. Exactly. So, Laura, I have a quick question. We can delete this.
Sure.
From I meant to ask it earlier. You are a private bookkeeper? I mean, you have your own
I am.
business?
I do.
Okay.
If you look at my website is easyoffice.com.
Okay.
And I have all my regular board of clients. Their tax stuff is turned over to the accountants already.
Right.
So I do have openings if you've got people coming through. Right now, the accountants are sending me the folks who, they show up and they're like, I don't know, my bookkeeper disappeared 6 months ago and I don't know what to do.
Yeah.
And so they're sending them over to me now because I'm done with the other stuff. I try to get my stuff done in February, or usually towards like middle of February, I'm done. Everything's turned in.
Right.
I usually like to go to Mexico in March.
Nice. Very nice.
But here I am. So if you've got folks that need a bookkeeper,
Sure.
feel free to call me. We can visit about. Yeah,
Okay.
I've been doing it a long time.
Okay, great. Thank you. I'll check out your website. Yeah, I've given up I've given up snow skiing 35 years ago when I became a CPA or an accountant because I can't get away from December to April.
Mhm.
And the last 2 years, it's been either May or July that my tax season is extended to.
I have a
Yeah, last year especially.
Yep.
Yeah, we
So
have a
I'm going to stop sharing my screen.
Becky, do you have a question or was it somebody else?
I have a quick question. Can you hear me okay?
Yes.
Oh, okay. My husband's in the process of retiring and we each have our own businesses. And our youngest son just turned 19. And a lot of the reason we postponed him retiring was because we wanted to make sure we got all the credits for having a minor child, not minor child, but child under 18.
Right.
So now that he's over 18, would this be a good time then to have him become an employee of my business? Because we don't need to show really income for him anymore?
Yes.
Okay.
Yes. Now, over 18, you're going to have to pay wages. But up to $12,400, if that is all the earnings he has, it will be subject to Social Security and Medicare. But it's not, being a family member, it would exempt him from the unemployment insurance because the IRS figures that working for parents, they'll provide any unemployment
Okay.
compensation and so on. But he could be exempt from federal and state income tax
Okay.
up to $12,400. He would be exempt from income tax, but you would save on $12,400 of income tax.
Yeah.
Absolutely.
Okay. This is great. Everything you said tonight really reframes how we go into retirement. So I'm so happy to hear some of these ideas. It's been a really great presentation.
Thank you. Thank you. Okay.
Well, thank you.
Anybody else?
I appreciate all the time you spent with us.
Anybody else have any
You're
other
quite
questions?
welcome. And it wouldn't surprise me that we see a whole bunch of other CPAs retire in the next year after all these two whopping tax changes just in the last 2 years. So keep me in mind.
Yeah. Well, you have a
Right,
good
thank you.
personality too. That's bonus.
That's what I like to think. Well, that's why I call myself not your ordinary bean counter.
Yeah, this was great.
All right.
Yeah, Kevin, very much appreciate your the amount of time you gave us. That was just absolutely fabulous. Plus, you know, the fact that all your content was applicable to, I think, the vast majority of us.
Yeah.
Really great presentation. Really appreciate you attending. And as Eric said, I hope we can get you on a regular basis about this time of the year.
Sure. I'll put it as a repeating event on my Outlook
There
calendar.
you go.
We would very much appreciate that.
Okay.
Hopefully we can get you some larger audiences.
Sure. Good.
So if anybody doesn't else have any questions, we can go ahead and stop the recording now, Eric or Sandy, and